Today I will be talking about why companies or businesses use financial statements. There are many ways to present information about an organization, but why do most organizations and stakeholders require financial statements? The reason being is that a financial statement is a simplified format, which presents information that are most relevant to stakeholders, highlighting numbers and figures which convey a story and current status of financial performance. Also, it provides guidance to help stakeholders in their decision making, as the information is a valuable source to determine whether there is success or failure in an organization. In order to perform effective decision making, financial statements have to be clear and accurate. Otherwise, information that will be presented would be unclear and confusing for companies and stakeholders. To ensure that financial statements present clear and accurate information and achieve consistency, a set of guidelines are enforced which are internationally governed by the IASB, the International Accounting Standards Board, and domestically governed by the AASB, the Australian Accounting Standards Board. However, there are limitations in the information which financial statements present, as it presents only numbers and figures, or in other words, financial information. Other information, such as non-financial information, that has less numbers or no numbers at all. An example includes an auditor's report, where someone assesses the presentation of the financial statement whether it meets the governing standards. This is added to support stakeholders' status, current performance, and presentation within presented financial statements. Lastly, primarily there are four main financial statements, which are as follows. 1. Statement of financial position, which shows a company's assets, liabilities, and equity over a specific point in time. 2. Statement of comprehensive income, which highlights the revenues and expenses in a point in time. 3. Statement of changes in equity, which shows how much of retained earnings a company has earned over a specific period of time. And lastly, 4. Cash flow statement, which shows the inflows and outflows of cash over a specific period of time and is divided into three parts, which are operating, investing, and financing. Furthermore, relationships are formed over the four main statements. For example, you can find net profits from the statement of comprehensive income in the statement of changes in equity, and others would be retained earnings and ending cash balance, which would be found in the statement of financial position.